My cousin Marcus checked his credit score every single day for 6 months straight. Every single day. His score dropped from 680 to 610. He was convinced checking his score was destroying it, so he completely stopped monitoring his credit for an entire year. When he finally checked again, his score was 580. He'd missed 3 fraudulent charges totaling $4,200 that he didn't even know existed. That one myth, that checking your credit hurts it, cost him over 100 points and nearly cost him his mortgage approval. And here's the crazy part. Marcus is a smart guy, college educated, good job. But he believes something that millions of Americans believe right now. Something that's completely, totally, 100% false. Today I'm exposing 5 credit myths that are keeping your score trapped under 700. And I guarantee you believe at least 2 of them right now without even knowing it. These myths aren't just wrong, they're expensive. They're costing people thousands, sometimes tens of thousands, in higher interest rates, denied loans, and lost opportunities. Stick with me, because what you're about to learn could be worth more than any college course you've ever taken. Myth number 1. Checking your credit score destroys it. The Marcus mistake. Let's start with the myth that nearly ruined Marcus's life. People are terrified to check their own credit score. They think every time they look at it, it drops 5 points, 10 points, whatever number they've heard. Here's the truth that nobody told Marcus. Checking your own credit score does nothing, absolutely nothing. 0 damage, 0 impact. It's called a soft inquiry, and soft inquiries are invisible to your credit score. But wait, you're thinking, I heard that checking your credit hurts it. You heard half the story. Here's the full truth. When you check your score through your bank app, Credit Karma, or even when you pull your free annual report, soft inquiry, no damage. When a lender checks your credit because you applied for a credit card, car loan, or mortgage, that's a hard inquiry. And yes, that can drop your score by a few points, usually fewer than 5 points. But here's the kicker. Even hard inquiries barely matter. They fade fast. Within 12 months, they stop affecting your score completely. The research shows hard inquiries account for maybe 10% of your score. Payment history, 35%. Utilization, 30%. So worrying about checking your score is like worrying about a paper cut while ignoring the broken leg. Marcus's real problem? By not checking his score, he missed those fraudulent charges. 3 unauthorized accounts opened in his name, racking up late payments, destroying his credit month after month, all because he was scared of a myth. Here's what you need to burn into your brain. Check your credit score. Check it monthly. Check it weekly. Check it every damn day if you want to. It will not hurt you. You can't fix what you don't measure, and you can't catch fraud if you're not watching. Myth number 2. You need a big salary to have good credit. The broke millionaire. Here's a story that'll blow your mind. I know a guy, let's call him David, who makes $400,000 a year. Tech executive, big salary, nice house, fancy car. His credit score? 590. I also know a woman, Maria, who makes $38,000 a year working as a medical assistant. Her credit score? 780. How is that possible? Because here's the secret the credit card companies don't advertise. Your income doesn't matter for your credit score. Not even a little bit. The credit bureaus don't even look at your income when calculating your score. You could be making minimum wage or making $1 million a year. The algorithm doesn't care. It's not even in the equation. So what does matter? Payment history. 35% of your score. Do you pay your bills on time? Credit utilization. 30%. Are you maxing out your cards or keeping balances low? Length of credit history. 15%. How long have you had credit? Credit mix. 10%. Do you have different types of credit? New credit inquiries. 10%. Are you constantly applying for new accounts? Notice what's missing? Income. David makes 400 grand but constantly maxes out his cards and pays late because he's disorganized. His score is trash. Maria makes 38,000 but pays every bill on time and keeps her credit card at 15% utilization. Her score is excellent. The myth that you need money to have good credit is keeping people trapped in a poverty mindset. You don't need to be rich. You need to be consistent. Pay on time. Keep balances low. That's it. That's the game. Myth number 3. Carrying a balance helps your score. The interest payment scam. This myth makes me furious because it's costing Americans billions in unnecessary interest payments every single year. Someone, somewhere, told you that carrying a balance on your credit card helps build credit. That person lied to you, or they were lied to themselves. Here's the truth. Carrying a balance does nothing for your credit score. Actually, it can hurt it. And worse, you're paying interest for absolutely zero benefit. Let me break down where this myth comes from and why it's destroying people financially. People confuse using your credit card with carrying a balance. Using your card, good, it shows activity. Carrying a balance, bad. It increases your utilization and costs you money. Here's what you should actually do. Use your credit card for purchases throughout the month, then pay it off in full before the due date. That's it. That's the strategy. You show activity. You keep your utilization low. You pay zero interest. But millions of people are carrying balances because they think it helps their credit. So they're paying 18%, 22%, sometimes 29% interest on money they don't need to be paying interest on. Let's do the math real quick. Say you carry a $2,000 balance at 20% interest, making minimum payments. Over 5 years, you'll pay over $3,000 total. That's $1,000 in pure interest for zero credit score benefit. The credit card companies love this myth. It's making them rich while keeping you poor. Here's the reality. Credit scoring models want to see you using credit responsibly. That means keeping your utilization low, preferably under 10%, and paying on time. Carrying a balance does neither of those things. It increases your utilization and costs you money. So stop. Today. Right now. Pay off your balance in full every month. Your credit score won't suffer. Your wallet will thank you. Myth number 4. Closing old cards. Cleans up your credit. The decluttering disaster. I see this mistake constantly. People think they're being smart by cleaning up their credit. They've got 3 or 4 old credit cards they don't use anymore, so they close them. Simplify. Declutter. Then their score drops 30 points and they have no idea why. Here's what's happening behind the scenes. When you close a credit card, you delete its credit limit from your total available credit. Let me show you with numbers because this is critical. You have 3 cards. Card A, $5,000 limit, $1,000 balance. Card B, $5,000 limit, 0 balance. Card C, $5,000 limit, 0 balance. Total available credit, $15,000. Total used, $1,000. Utilization, about 7%. That's excellent. That's 800 credit score territory. Now you think, I don't use card B or C. Let me close them and simplify. You close those 2 cards. Suddenly, total available credit, $5,000. Total used, $1,000. Utilization, 20%. Your utilization just tripled. Your score drops. But wait, it gets worse. Closing old cards can also hurt the length of credit history portion of your score, which is 15% of the total. If card B was your oldest card, maybe you've had it for 8 years, closing it can age out of your credit report eventually and shorten your average credit history. So what should you do instead? Keep the cards open. You don't have to use them regularly. Just make a small purchase every few months, a tank of gas, a coffee, whatever, then pay it off immediately. This keeps the card active, preserves your available credit, and maintains your credit history length. The only time you should close a card is if it has a massive annual fee that you can't justify, or if you genuinely cannot control your spending and keeping it open is dangerous. Otherwise, leave it open. It's helping you more than you realize. Myth number 5. A perfect score guarantees approval. The 800 score rejection. This one shocks people every time. Someone spends years building an 800 credit score, perfect payment history, low utilization, great credit mix. They've done everything right. They apply for a mortgage, or a business loan, or a premium credit card. Denied. Wait, what? How does someone with an 800 score get denied? Because credit scores aren't the only thing lenders look at. Not even close. Here's what lenders actually evaluate. Your credit score? Yes, that matters. But also, your income. Can you actually afford this loan? Your employment history. Are you stable or do you job hop? Your debt-to-income ratio. Are you already stretched thin? The amount you're borrowing. Is it reasonable for your situation? You could have an 850 credit score, literally perfect, but if your debt-to-income ratio is 50% because you've already got massive student loans, a car payment, and other debt, lenders might say no. Or maybe you're self-employed and your income fluctuates wildly. Even with perfect credit, some lenders get nervous. Or maybe you're trying to borrow way more than your income supports. The point is, your credit score opens doors, but it doesn't guarantee anything. Most lenders want your debt-to-income ratio below 43%, ideally below 35%. That means your total monthly debt payments should be less than 35% of your gross monthly income. So don't just chase a high credit score, build a complete financial profile. Strong credit score, ideally 740 plus, stable income with documentation, low debt-to-income ratio, consistent employment history. That's what gets you approved, not just a number. All right, let's bring this home. Marcus nearly lost his mortgage because he believed a myth. David makes 6 figures but has terrible credit because nobody taught him the truth. Millions of people are paying interest they don't need to pay. These myths aren't just wrong, they're expensive. But you just got the truth. All 5 myths exposed. So here's what I need from you. If this video just saved you from making a costly mistake, absolutely smash that like button right now. Subscribe to this channel if you want more financial truth that actually matters, not the watered-down BS you see everywhere else. And here's the big one. Drop a comment telling me which myth you believed. Be brutally honest. Was it the checking your score myth, the carrying a balance scam, the closing cards trap? I read every single comment, and I'll respond to as many as I can. Oh, and if you know someone, a friend, family member, coworker who's struggling with their credit and believes these myths, send them this video right now. It could literally change their financial life. Your credit score isn't some mysterious, unchangeable number. It's a reflection of your habits. And habits, those can be changed starting today. I'll see you in the next one. Now go check your credit score, yes, right now, and make sure everything looks correct.